This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Power and protests. World leaders head to Germany, are greeted by demonstrators, but not before President Trump promoted U.S. natural gas exports in Russia's backyard.
Triple-digit decline. It wasn't just one thing that dragged down the stock market. Instead, it was many.
And behind the wheel, are you driving one of the safest cars on the road today? Those stories and more tonight on Nightly Business Report for Thursday, July 6th.
Good evening, everyone, and welcome. Stocks were treated today, and you can have your pick of the reasons why. Some say it's because interest rates are ticking up, not just here, but globally. Others say it's because technology stocks slid again, and so did energy. Then there are those who cite today's lackluster economic reports. And then, of course, there are rising geopolitical tensions overseas. But whatever the reason, the Dow Jones Industrial Average dropped 158 points to 21,320. The Nasdaq was off 61, and the S&P fell 22.
And whatever the reason or reasons for the market slide today, lots of investors did have at least one ear cocked toward Europe, Germany in particular, where world leaders of the Group of 20 are meeting. They were greeted by protesters, not uncommon at global meetings like this, and certainly not unexpected in a town like Hamburg. It has long been a hotbed of anti-capitalist demonstrators. Before decamping for Germany, President Trump was in Poland, where he explicitly endorsed NATO's Mutual Defense Clause after failing to do so during his previous European trip. He also made a veiled jab at Russia. Eamon Javers reports tonight from Hamburg.
Trump took to the podium in Warsaw, Poland, to cheers from a packed crowd earlier today, recounting the bonds between the two countries and a desire to forge stronger economic ties.
We welcome stronger ties of trade and commerce as you grow your economies. And we are committed to securing your access to alternate sources of energy, so Poland and its neighbors are never again held hostage to a single supplier of energy.
A message Trump emphasized this morning at a meeting of Central European countries, pitching U.S. energy exports to Europe as an alternative to supplies from Russia, though never directly naming the country.
We're here at this historic gathering to launch a new future for open, fair, and affordable energy markets that bring greater security and prosperity to all of our citizens. We are sitting on massive energy, and we are now exporters of energy. So whenever you need energy, just give us a call.
Trump congratulated Poland on its first shipment of U.S. liquefied natural gas last month and also pushed the idea of a long-term contract.
We can enter a contract for LNG within the next 15 minutes. Do you have anybody available to negotiate? It will take about 15 minutes.
The Trump administration hopes to ship more LNG to the region, thereby reducing the U.S. trade deficit and boosting U.S. influence.
He and the leaders of all of the Eastern European countries, because he met with all of them in Warsaw, not just Polish Prime Minister Duda, are very interested in becoming energy, that means natural gas, independent of Russia, and all of Europe becoming energy independent of Russia to avoid this destabilization that the president talked about.
Late today, Trump arrived in Hamburg as protesters led by anti-capitalist groups gathered to demonstrate against the G20 summit. Police expecting as many as 100,000 protesters from across Europe. Well out of reach of the demonstrations, President Trump met with German Chancellor Angela Merkel this afternoon, speaking about a range of issues from the Middle East to North Korea. A topic that will be central to Trump's meetings with China's President Xi and Russian President Vladimir Putin, both slated for Friday. The official G20 agenda includes meetings tomorrow on trade, climate, and energy, although all eyes will be on those meetings with Vladimir Putin and President Xi Jinping of China. For Nightly Business Report, I'm Eamon Javers in Hamburg, Germany.
While the global markets keep watch on these high-level meetings in Europe, there's another trend that investors need to watch as well. More money continues to be put into passive index funds, or ETFs, as opposed to actively managed ones that pick stocks. And according to a new report, is having an impact on the market. Dominic Chu explains.
It's no surprise that exchange-traded funds, or ETFs, have exploded in popularity over the course of the last decade. ETFs combine three of the most important factors for the everyday investor: index investing, low fees, and intraday trading ability. But is the ETF business getting a little too big? According to a report from strategists at Bank of America Merrill Lynch, index investing strategies now account for 37% of all stock fund assets held in America. That's nearly double what they had back in 2009. Looking for another sign of just how big passive investing strategies have become? Index fund pioneer and giant Vanguard now owns at least 5% stakes in 491 of the S&P 500 companies. What's more, Vanguard now owns just about 7% of the entire value of the S&P 500. Back in 2010, it was only half that amount. ETFs now account for a quarter of all trading volume in the United States. So with so much money tied up in ETFs and other index-related investments, there are now concerns that markets could experience more volatility in times of stress, as many could look to sell the same investments at the same time. Index-related investing has a slew of benefits for the investing public and have been advocated by investment managers and even Warren Buffett himself for years. But could there be unintended consequences down the line because of it? Time will tell. For Nightly Business Report, I'm Dominic Chu.
To the economy now, where American businesses did not create as many jobs last month as expected. The ADP private payroll report for June showed an increase of 158,000 new positions. Expectations were for 185,000. Maybe they just transposed those last two numbers. Just kidding. Economists consider the report to be another sign that the economy is getting closer to full employment. The government releases its monthly employment report tomorrow.
The services sector expanded at a healthy pace last month, a sign the broadest segment of the economy is gaining momentum after a lackluster start to the year. The Institute for Supply Management cited a pickup in business activity and new orders last month. Service providers include everything from accounting to healthcare.
Federal Reserve official is calling for an overhaul of the housing finance system in this country. Governor Jerome Powell said the current system is putting taxpayers at risk because the mortgage market is dominated by government-backed agencies with a high concentration of mortgages in Fannie Mae and Freddie Mac. He added that the window for political action may not stay open for long. Treasury Secretary Mnuchin has called housing finance reform a top priority.
Meantime, the commercial real estate landscape could also be reshaped by Amazon's plan to acquire Whole Foods. Just today, the ETF that invests in real estate investment trusts fell about 1.5%, its largest drop since early March. Diana Olick has more.
The Amazon Whole Foods deal may sound like a food story, but really it's a real estate story. The value of strip mall centers with a Whole Foods just shot up.
If you have a Whole Foods center in place, we're likely to see increased foot traffic, which leads to higher demand for space, and we would expect that retailers would want to be around those Whole Foods where there's that activity.
Increased foot traffic will come from those who may have stayed away before because of higher prices. Now they have a reason to go if prices are lower, and maybe they're picking up some bedding they ordered on Amazon. Other centers with competing grocers are likely to see less foot traffic, which will hit the grocers, connected stores, and the real estate underneath even harder.
You might see a degradation, you might see situations where rent growth stagnates, and at the end of the day, that's all happening because the best retailers are likely to desire being near the Whole Foods-oriented center.
These centers are owned by publicly traded real estate investment trusts, or REITs, which could take a big hit. Regency, ROIC, and Weingarten are the most exposed to Whole Foods competitors. On the plus side, REITs that own strip centers with Whole Foods, like American Assets, could do very well. Two competitors that an Amazon Whole Food deal are unlikely to hurt are ethnic and value-oriented shopping centers. They don't compete, and underlying real estate for both should continue to see strong demand. For Nightly Business Report, I'm Diana Olick in Washington.
Amazon may also be eyeing another deal. There are reports today that the CEOs of Amazon and Dish Network discussed a partnership to enter the wireless business. According to the Wall Street Journal, Amazon could help finance a network Dish is building focused on the Internet of Things, which, as we've reported, is the idea that everything can be connected one way or another to the Internet. It is also being reported that Amazon could potentially offer an option for Prime members to pay a little bit more each month for a phone plan. No deal is imminent, and it is not clear that the two companies will move forward. Today, the stocks went in opposite directions. Amazon lower, Dish a little higher.
Still ahead, changes in the corner office, why some of the most powerful and influential CEOs may be feeling a bit anxious. 18 states have filed a lawsuit against the Secretary of Education and her department. At issue is the delay of an overhaul of rules that would help ease the federal student loan debt of borrowers defrauded by colleges. The rules had been scheduled to take effect July 1st. Secretary DeVos was critical of them and said that she would establish a new committee to reconsider the matter. But the attorneys general are seeking to have those rules restored.
The U.S. lifted the laptop ban for Qatar Airways and the airport in Doha. It is the latest carrier to meet all requirements of the U.S. Department of Homeland Security's new guidelines. Passengers can now bring laptops and tablets into the cabin on flights into the U.S. Etihad of Abu Dhabi, Emirates of Dubai, and Turkish Airlines have also had the ban lifted in recent days. The U.S. introduced the prohibition in March, and it still applies to U.S.-bound flights from 6 other airports in the Middle East and Africa. It continues to affect 5 airlines.
And there's another type of travel ban, one that has nothing to do with laptops. California's Attorney General recently announced the expansion of a ban on state-funded travel to 4 states he says discriminate against the LGBT community. It is setting up a different type of battle between states, which usually fight over things like tax breaks and incentives. But in this battle, California is claiming the moral high ground. Scott Cohn reports tonight from Silicon Valley.
This comes after a number of states passed laws involving religious freedom and LGBT rights, and companies demanded inclusiveness. Now, California says it is banning state-funded travel to 4 states that it says discriminate against LGBT people. They are Alabama, Kentucky, South Dakota, and Texas, on top of already banned states North Carolina, Mississippi, Kansas, and Tennessee.
To travel to these states at state expense would mean that we would be using taxpayer dollars to support these states, and we think it would be an offense to all those individuals in America who feel the scourge of discrimination.
California Attorney General Javier Becerra says he's following a state law passed last year that he says requires the ban. So, has it had any effect? Not much. The governor of Texas says through a spokesman that California may be able to stop its state employees from traveling, but it can't stop all the businesses that are fleeing the state to go to Texas. The governor of Kentucky blasted what he called West Coast liberals trying to dictate his state's laws. But the mayors of Louisville and Lexington, Kentucky's largest cities, both asked California for exemptions from the ban, citing their own cities' protections. But California said no. The mayor of Louisville says his city has lost $2 million in convention business already because of fears about the ban spreading. Protests against state laws in the past have had limited impact. After Indiana passed its so-called Religious Freedom Restoration Act a couple of years ago and businesses complained, the state amended the law, but the law itself remains on the books. And North Carolina repealed its so-called bathroom bill, but the state still bars local municipalities from enacting their own anti-discrimination ordinances. Many companies have been calling for inclusive state laws to help them attract workers. Now the states are battling it out in a nationwide culture clash. For Nightly Business Report, I'm Scott Cohn in Mountain View, California.
As a number of cities increase their minimum wage, Missouri is preparing to lower it for St. Louis. The governor says the hike to $10 an hour was a job-killing mistake, and next month the minimum wage in that city will return to $7.70 an hour. That's the standard across the state. A bill was recently passed by the state legislature that bars cities and counties from setting their own minimum wage above the state's minimum.
QVC's parent goes on a shopping spree of its own, and that's where we begin tonight's Market Focus. Liberty Interactive will buy the 62% of rival HSN that it didn't already own in a deal valued at more than $2 billion. The deal combines two television home shopping networks, which will also have a strong e-commerce presence. The merger will allow the companies to combine and cut costs. Shares of HSN jumped about 27% to $39.70, while Liberty Interactive fell nearly 3% to $24.14. Celgene will buy a stake in the Chinese biotech company BeiGene to help develop its treatment for solid tumor cancers. That deal helps Celgene expand its reach into the immuno-oncology space. BeiGene rose about 27% to $66.28, and Celgene was off 1% to $131.95. Shares of L Brands dropped after the specialty retailer reported a bigger than expected sales miss in June. The operator of Victoria's Secret and Bath & Body Works said dropping swimwear and apparel categories had a negative impact on sales. L Brands fell 14% to $46.49. And Costco posted a rise in monthly sales numbers. The retailer reported net sales in June of more than $12 billion. That's up 7% from the year-ago period, but it still wasn't enough for Wall Street. Shares were off 0.5% to $157.09.
Berkshire Hathaway's energy business could be nearing a deal to buy Encore, one of the country's largest electricity transmissions businesses, according to the Wall Street Journal. Last year, NextEra Energy's $18.5 billion bid for Encore was rejected by regulators in Texas. And just because we love to show it, Berkshire shares were off a fraction. That's a fraction. $1,950 a share to $255,550. Those are the A shares, folks. And as we told you last week, this was coming, but today Microsoft announced a major shakeup that will include thousands of layoffs. The tech giant said the cuts will mostly be in sales as the company aims to change the way it sells cloud services. Shares of Microsoft were off 51 cents to 68.57. And Endo International took its opioid painkiller Opana ER off the market amid rising concern about addiction and overdoses. Last month, we told you the Food and Drug Administration asked for the drug to be removed, saying the benefits no longer outweighed the risk for abuse. Endo shares down 2% today to $11.17.
Despite the departure of some of the nation's top chief executives from big-name companies like GE and Uber this year, pay is still great. According to the research firm Equilar, CEO pay rose 6% last year, the highest it's been in 3 years. So why then do things seem to be a bit shaky for CEOs at some of the biggest and best companies? J.P. Eggers, professor of management at New York University's Stern School of Business, joins us to talk about that. Welcome back, Professor. Nice to have you here.
Thank you, Sue. Glad to be back.
Tell me how you see this picture. Maybe it is the size of the companies where we've seen the turnover in the corner office. I'm not sure. Why do you think we're seeing so many CEOs recently, anyway, get booted out of the corner office?
So we've certainly seen some very big, high-profile turnover events relatively recently. The overall numbers look like they're up, but it maybe not up dramatically. But I think the high-profile nature of this is really what's kind of catching everyone's attention. These are big-name companies who've been around for many, many years, and many of whom have been struggling very mightily with the technological changes that have been going on in the environment. And they've been looking around for solutions, and the performance has just not been there.
How much of the change, JP, is traceable to the fact that some of these companies' stocks have been targeted by activists?
So certainly one of the big things that can break the typical inertia that exists on boards of directors would be an outsider coming in, buying up enough shares to get a real voice or a seat on the board and kind of pushing for some significant change. The data seem to suggest that we're seeing more activist targets this year than we've seen in recent years. And that's certainly going to have a significant impact on CEO turnover at these companies that are struggling, as the activist investors themselves don't have a great solution for how to solve the company's problems, but see a turnover event as at least a chance to try a different path for the company.
Right. I talked to an analyst today who also suggested with volatility, in some cases at record lows in the market, one of the only way that activist investors can make a significant amount of money is not in the market itself, but by moving the stocks of those companies that they move into.
This has absolutely been the most successful strategy for most activist investors. It's not simply kind of playing in the market and kind of making suggestions. It's actually having enough ownership and enough of a voice to actually affect change in the company. It may take them a while to unwind the stock that they own, that they hopefully can get a return on for them. But this has absolutely been a tactic that's become more and more common as enough of these activist investors have got big war chests and can target some of these big name companies.
So are boards giving CEOs less time to do what they need to do to fix companies? I'm thinking in the case of Ford, where Mr. Fields was booted out after 3 years.
Certainly, given the amount of change that a lot of these companies need to go through, the idea that within 2.5 to 3 years you would expect to see clear evidence of progress seems like too short a period of time. So if that's really what boards are bringing in new CEOs expecting, that Ford wasn't really struggling, but still a company that was looking to figure out its place in this kind of emerging technological landscape, if they think that they're going to find that within 2 or 3 years, or they're going to kick the CEO out, then that's a really tough job for a CEO to walk into, and certainly one that many people would not prefer to walk into at all.
Certainly. Professor Eggers, thanks so much for joining us. He's with New York University's Stern School of Business.
Coming up, speaking of cars, the safest cars on the road and the fastest one on the planet. In a story we've been following for you, Illinois finally has a budget. Its first full-year budget since 2015 became law after the state's House of Representatives overrode the governor's vetoes of the $36 billion spending plan and $5 billion increase in income taxes. The Senate did the same, overriding the veto on Tuesday.
A new round of crash tests are shining a light on the safety of larger cars. While sales of these larger sedans have slowed in recent years, automakers have been working on improving their safety performance. Phil LeBeau has the result of the latest crash tests.
The bigger the car, the louder the crash. But the latest test from the Insurance Institute for Highway Safety found half of the large cars tested passed with flying colors. In fact, the Lincoln Continental, Mercedes-Benz E-Class, and Toyota Avalon earned the designation of top safety pick.
Large cars are a safer group, certainly by comparison to small cars. And these test results affirm that there are some very good choices in terms of safety in this car category.
One car that failed to earn top marks from the IIHS is the Tesla Model S. The company calls it the safest car ever, in part because it earned a 5-star rating following crash tests by the federal government. But the Insurance Institute does a slightly different test. In its collision of the front corner of the Model S, the crash test dummy's head hits the steering wheel.
When we see that they fail to do that, that raises concerns about the risk of a head injury. In this particular case, we didn't measure forces so high that we would say we know for sure a head injury is going to occur, but it does raise concern that in similar crashes, some people's heads will be inadequately protected.
Tesla defends its luxury electric car, saying the most objective and accurate independent testing of vehicle safety is currently done by the U.S. government, which found the Model S and Model X to be the two cars with the lowest probability of injury of any cars it has ever tested, making them the safest cars in history.
Whether it's the Tesla Model S or any other large sedan, these crash tests reinforce a position long held in the auto industry. There is safety in size. Larger cars are often considered among the safest on the road. Phil LeBeau, Nightly Business Report, Chicago.
The new Bugatti Chiron is the fastest and most expensive production road car in the world. Buckle up, because Robert Frank got to take it for a spin.
In the world of expensive cars, there are sports cars, supercars, and this, the Bugatti Chiron, a car that defies the laws of both physics and economics. It's the fastest production road car on the planet, with a top speed that remains a secret but goes well over 260 miles an hour. It's also the most expensive car in the world, starting at $3 million, and that's before customization options like exposed carbon fiber and your own name engraved in LED lights along the running boards. 0 to 60 miles an hour in 2.5 seconds, driven by an engine that's 16 cylinders with a quad turbo that's all internal combustion. In fact, if you drive this car flat out, you would drain the gas tank in just 9 minutes. Now, Bugatti plans to make 500 of these cars. They've already sold half. Each of them takes 6 months to make. The U.S. is the largest market, and none of them have been delivered to the U.S. yet. The car I'm driving today is one of the first, and we are some of the first to drive it. The average Bugatti buyer owns 42 vehicles, 3 private jets, 3 helicopters, 1 yacht, and 5 homes.
Our customers come from all different areas of the business world, sports world, entertainment world, but you can see that all of them are extremely successful and very focused, and I think you can tell that they demand the best out of about everything they have.
This is the follow-up car to the Bugatti Veyron, which had been the fastest car in the world and finished production in 2015. Before this car was launched, Bugatti almost killed the program during its emissions scandal, but the Chiron was saved by Bugatti's president, given the already strong demand for the car. For Nightly Business Report, I'm Robert Frank in Greenwich, Connecticut.
I think if you can afford one of those cars, you can also afford the racetrack where you can run it full out. Because you're not going to be able to do that for very long on the Merritt Parkway.
No, you're not. That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody, and we'll see you back here tomorrow night.